Assalamu alaikum everybody. Welcome back to my channel Rapid Revision. In today's video, I'll be solving a depreciation question from A-level accounting, that is 9706, which is AS level accounting. But before that, I want to tell you guys a new concept which is called part exchange or trade in. So what is part exchange or trade in? So let's say, for example, if I give my old laptop to someone and buy another laptop from them. So I am exchanging one non-current asset for another non-current asset. So in O-level accounting, you guys are not doing that in any of the depreciation questions, because whenever you're disposing of your non-current asset in O-level accounting, you're either taking the money money against it. So either you're taking it through a check, so the other person is giving us a check, or the other person is paying us in cash, or we are selling the non-current asset on credit. So we are basically expecting that person to pay us in future. And that are the three ways in which you dispose of the non-current assets in O-level accounting. But in A-level accounting, there's something called part exchange, and part exchange is actually very applicable to real life as well, because in reality what you do is that whenever you're buying a non-current asset, you basically sell the old non-current asset and buy the new one. So that means you give your old non-current asset and get a new non-current asset in exchange. So let's say if I give my old laptop, so my old laptop, I want to get a new laptop. Okay, so the new laptop, let's say, is for, okay, the new laptop, let's say, is for rupees 200,000, which I want to buy. But my old laptop, so the seller from whom I'm buying the new laptop, that guy basically tells me that for my old laptop, they will give me an allowance of 50,000, let's say. So I will basically, so this is kind of my selling price for my old asset, but I'm going to exchange it for a new laptop. So what I'm going to do is that the 50,000 thing will be, obviously I'll give my old laptop and then I will pay them 150,000, so that I get the new laptop, right? So because I'm giving the old laptop, so the allowance for it is 50,000, and then what the seller is saying, okay, the other laptop that I'm getting, I'm going to give 150,000 more to that person to actually get the other laptop that I want to buy. So now the thing is that, for in this case, the allowance was 50,000, right, for the old laptop. So the allowance, also the old laptop, the amount that was decided between the buyer and the seller. um, so for the old laptop, is this allowance is also the selling price of my old non-current asset. But in this case, basically it's like an exchange, also called part exchange, and it's also called trade in. So what you guys need to do is that when you will solve a question which you have part exchange, you need to know how to deal with part exchange in terms of T accounts also. And it's not very difficult. It's something which is not very difficult. It can be understood. Okay, May June 2020, 2014, paper 2, variant 1, question 29706. The question here says Richard commenced business on 1st May 2011. At the end of the first year of trading, that is when the first year ends, that will be 30th April 2012. That is my ending. So the ending of first year is starts on 1st May 2011, ends on 30th April 2012. At the end of the first year of trading, okay, the year starts on 1st May 2011 and ends on 30th April 2012. At the end of the first year of trading, an extract from a statement of financial position showed non-current assets. So they have three non-current assets, that is freehold land and buildings. Cost is 100,000, accumulated depreciation is 2,000. Machinery cost is 64,000, accumulated depreciation is 16,000, and motor vehicle cost is 12,000 and accumulated depreciation is 3,600. And they've given you net book values for each of the non-current assets. Then they are saying Richard has a policy to depreciate non-current assets as follows: buildings at 2% per annum on cost, machinery at 25% per annum on cost, motor vehicles at 30% per annum using the reducing balance method. Then they are saying depreciation is charged for each month of ownership. We have this policy, monthly policy, in the O-level syllabus as well. Then they're saying on 1st August 2012, additional machinery costing 18,000 was purchased. On 1st January 2013, a new motor vehicle costing 24,000 was purchased. So we got a new motor vehicle. On the same date, the old motor vehicle was traded in. So this is a part exchange question. Richard received an allowance for 2600 of 2600 against the cost of the new vehicle. The vehicle disposed had an original cost of 12,000 and was purchased on 1st May 2011. So basically, they are talking about this motor vehicle which they are exchanging for another motor vehicle. So the motor vehicle that they are exchanging, and the allowance here is 2600. So the allowance for my old motor vehicle is 2600, and the new motor vehicle that I'm purchasing is for 24,000. So what I need to do is that I need to all payments and receipts of purchases for purchases and disposals were in cash. So I need to basically record 24,000 minus 2600 is what I'm supposed to pay. So this is 21,400 which I will pay for the new asset, that is the new motor vehicle that I have purchased. So it's very simple. So in the requirement, they're saying prepare the following ledger accounts for the year ended 30th April 2013. Dates are not required. They're saying motor vehicles at cost account. So you need to prepare a motor vehicles cost account, which I'll simply make a T here, and I will start with a balance brought down. So the current year is 1st May 2012 to 30th April 2013. This is going to be my current year. So I'll simply start with a balance brought down. I'll write here 1st May 2012. I'll write here balance brought down, and I will write here 12,000, which is also my balance brought down. Why? Because at 30th April 2012, the cost of motor vehicles was 12,000. So at 1st May 2012, the cost of motor vehicles at start will be 12,000. And then what you are doing during the year is that we are disposing of this asset which originally costed us 12,000. So I'll write here disposal on the credit side. And like I've always told you guys that in the motor vehicles cost account, you need to write the original cost of that asset which you have disposed of. So the original cost was 12,000, and the date of disposal is 1st January 2013. On the same date, we are also trading this asset with another asset. And because I'm trading in, right, so I'm going to write here on the debit side, I'll write here 1st January 2013, and I'm going to basically record the new motor vehicle into two parts. So the new motor vehicle that I'm going to record here, number one, I will write here disposal, and I'm going to write trade in the brackets. So trade in, and this is going to be 2600. So the part of my non-current asset which I am buying, the new non-current asset, the part of it is basically paid off through my old non-current asset, that is my old motor vehicle, which a part of the new non-current asset, a part of the cost of the new non-current asset is paid off through my old motor vehicle. So I'm going to write disposal trade in 2600, and I'm going to write here cash, and I'm going to write here 21,400. So notice this, that when you add both of these, this is going to add up to 24,000, which is the cost of the new motor vehicle that I am purchasing. But the a part of it, $2,600 of the new motor vehicle I'm paying through giving my old motor vehicle. That is why I need to write disposal trade in the brackets. And now I will calculate my balance carried down. So it is very simple. My balance carried down is going to be 24,000, because when you do total of debit minus total of credit, you will get 24,000. And notice that you had a balance brought down of 12,000, but you have also sold uh, the asset which costed us 12,000. So I need to remove 12,000 from this account. So basically I'm left with one motor vehicle that is of $24,000. This will be 30th April 2013, balance carried down. Now my account is going to balance at 36,000 on both sides. Total will be 36,000. And then this balance carried down will become my balance brought down. I will write here 24,000, and this will be 1st May 2013. This is going to be 1st May 2013. And then I need to prepare the provision for depreciation of motor vehicles, which I will prepare. It's not very difficult. I need to make this T account, and then I'll start with a balance brought down. For provision for depreciation, balance brought down always comes on the credit side, because provision for depreciation is a contra asset. Contra asset means opposite of asset. So whatever rules are there for assets, there are opposite rules for uh, provision for depreciation. So this is going to be 1st May 2012. I'm going to write here balance brought down. And notice, so at 30th April 2012, the total depreciation on motor vehicles was 3600. So on 1st May 2012, this will be my balance brought down 3600. So balance carried down on 30th April 2012 becomes my balance brought down on 1st May 2012, which is the start of the year. Then what I'm doing here is, so you need to see, I'm going to use the old motor vehicle. That is my old motor vehicle that was for 12,000, right? So I was using this old motor vehicle. 12,000 was the cost, and 3,600 I had charged in the previous years. 3,600 was the accumulated depreciation multiplied by percentage. The percentage in this question for motor vehicles is 30%. But notice they have said you need to charge depreciation based on months of ownership. So if I'm using my non-current asset in the year of sale, right? So I'm using it for a few months. So I need to charge depreciation for that as well for the current year. So I'm basically calculating the value for income statement, and I will tell you guys how you calculate it. So basically I'm basically selling the old motor vehicle on 1st January 2013, right? So my year is starting in May. So if I count the months May, June, July, August, September, October, November, December. So I'm using the old motor vehicle for 8 months. So I'll simply 12,000 minus 3,600 multiplied by 30% multiplied by 8 divided by 12 is going to give me my depreciation for current year for the old motor vehicle, which is going to be 1680. Okay, so this is for my old motor vehicle. I'll write here old MV. So for the new MV I'm purchasing on 1st January 2013. So for the current year, I'm just using it for 4 months. So January, February, March, April, and then that's it till April. So I'm going to write here 24,000, and this is the cost of the new motor vehicle, and accumulated depreciation in the first year is 0, and then you multiply this by 30%, and then you multiply this by 4 divided by 12, because our policy is you need to charge depreciation based on months of ownership. So this is going to come out to be 2400. So 2400 plus 1680 is my income statement value here, which is 4080. So I'm going to write income statement on the credit side. I am going to write here 4080, which I have calculated here the value for income statement, and this is going to be 30th April 2013. 30th April 2013. And then I'm going to calculate a value for disposal. This is going to be 1st January 2013, the date of disposal, and disposal is going to be how much? So I have already charged in the first year of trading, we charged 3,600 as depreciation for the old motor vehicle, right? And in the second year of trading, when we are selling this motor vehicle also, the old motor vehicle, but we are using it for 8 months, and we have charged 1680 as depreciation for the second year, that is the current year, that is from 1st May 2012 to 30th April 2013. So this is going to be 1680 plus 3,600 is going to be my accumulated depreciation, which is 5280, accumulated depreciation of that asset which we have disposed of. And now simply I will calculate a balance carried down. So balance carried down is going to be on 30th April 2013. So balance carried down will be 4080 plus 3,600 minus 5280 is going to give me 2400. So 2400, and this account is going to balance at the total will be 7680 on both sides, 7680. and then this balance carried down will become my balance brought down. This is going to be 2400. This is going to be 1st May 2013. And now I'm going to prepare my disposal of motor vehicles account, which is pretty simple because I've done all the hard work in the previous parts. I will simply basically this thing that I have written in my motor vehicles cost account. So basically I have debited the motor vehicles cost account with the selling price. Also I have written disposal here, right? So I have debited the motor vehicles cost account. Also I've credited the motor vehicles cost account. So I'm going to record this thing, the credit side thing on the debit side of the disposal account. I'll write here motor vehicles. I'll write here 12,000. So this is going to be the cost of motor vehicles. And this is 1st January 2013. So this is the cost of that motor vehicle which I have disposed of. I'll write here 1st January 2013. So provision for depreciation. Provision for depreciation is basically the account is debited. So I'm going to record this on the credit side of the disposal account. I'll write here 5280. And the allowance that we have got for this asset which we have disposed of, I'm going to write this on the credit side of the disposal account because I have debited the motor vehicles cost account with 2600. That is the allowance for the old motor vehicles. So I'm simply going to write here motor vehicles. In the motor vehicles account, I have written disposal and I've written bracket trade in. So in the disposal account, I'm going to write motor vehicles and I'm going to write bracket trade in. And this is going to be 2600. This is the selling price of my non-current asset, the old motor vehicle. So 12,000 minus 5280 minus 2600 is going to give me 4120, which is my income statement, which is a loss here. I will tell you how is it a loss. This is going to be 4120. So 12,000 minus 5280, which is the accumulated depreciation. So 6720 was my net book value. 6720 was my NBV. But I sold this for only $2,600, which means my selling price is way below my net book value, and it is a loss of 4120 in this case. This is going to be 30th April 2013. This date is also going to be 1st January 2013, although dates were not required, but still I wrote the dates. And 12,000 on both sides. So that's it for these 3T accounts. This video is going to explain to you how to deal with part exchange. So if you get part exchange in the questions, and part exchange is part of A levels, it's not part of O levels. So it's not part of O levels in IGCSE, it's part of A levels. So calculate the depreciation charge for the year ended 30th April 2013 to be shown in the income statement, clearly identifying the amount charged for each category of assets. So we have three assets, right? We have freehold land and buildings. 100,000 is the cost. 2% per annum on cost is my depreciation method. So I'll simply write here 100,000. This is freehold land and buildings. 100,000 is 2 into 2% is going to give me 2,000. So $2,000 is the depreciation for freehold land and buildings. Then we have machinery. So for machinery, they have given you the method here. The method for machinery is 25% per annum on cost. So machinery cost here is 64,000, which is at the start of the year. So 64,000 multiplied by 25%. And there is another machinery that we have purchased during the year, that is on 1st August 2012. So that means August, September, October, November, December, January, February, March, April. So 9 months we are using this machinery, which is the new machinery. So I'll write here 18,000 multiplied by 25% multiplied by 9 divided by 12. So now I'm going to calculate. Okay, 64,000 multiplied by 25% is going to give me 16,000. And for the other machinery that I'm purchasing, 18,000 multiplied by 25% multiplied by 9 divided by 12 is going to give me 3375. When I add these both, 3375 plus 16,000 is going to give me 19375, which is the total depreciation of not the total depreciation, but the current year's depreciation expense for machinery. Okay, the last thing, that is motor vehicles. I have already calculated the motor vehicles current year's depreciation. The current year depreciation for motor vehicle is this income statement value that we have calculated, which is 4080. So I'll simply write here 4080 for motor vehicles. I have calculated 4080. So basically the calculation was 24,000 minus 0 multiplied by 30% multiplied by 4 divided by 12, which came out to be 2400. Also the old one, 12,000 minus 3600 multiplied by 30% multiplied by 8 divided by 12, because the old motor vehicle we used for 8 months and the new motor vehicle we used only for 4 months. So this was basically the breakdown of 4080, which we calculated for our T accounts. So I hope this helps you guys. This was especially for you guys because you guys requested me to make videos for A levels. Also, trade in is also called part exchange. So if you look at the marking scheme, they have written brackets, like I have written brackets trade in here. In the marking scheme, they have written PE. PE stands for part exchange. That's it. So thank you so much for watching. Hope this helps you guys.